All right, folks, I guess we'll get started here. Hi, everyone. I'm Ethan Zindler. I'm with Bloomberg New Energy Finance, and just want to say thanks very much to UNEP FI for hosting me here today and for letting me take part in this important session. I think we have an interesting panel. It follows, I think, fairly nicely on the last one. We're going to talk a little bit in detail about what's going on in North America, very specifically in terms of investment in clean energy and in some of the policy developments that could shape further investment in the sector going forward. So before we get started, just a few kind of housekeeping notes. There's been a couple minor changes I just want to let you know about. First, unfortunately, Jed Davis of Global Energy Assessment is not joining us today. And second, unfortunately, Bob Simon of the Senate Energy Committee is not joining us. But the good news is that we have in his place Mike Carr, who is the senior counsel to the committee, who's going to be speaking in just a few moments. In the interest of time and keeping us focused on content, I'm not going to read formal intros to everybody. Needless to say, we have three distinguished panelists who I think each are going to shed very important and unique perspectives on all this stuff. But I will read Mike's just because his bio is not in the program that I know all of you have. Mike is the senior counsel to the Senate Energy Committee on Natural Resources. His portfolio focuses on vehicle fuel efficiency, financing early commercialization of emergent energy technologies and related issues. Since graduating from Northwestern Law and Lewis and Clark College with the specialization in environment and natural resources law, Mike has advised on law and policy, both inside and outside of government. He managed environmental and appropriations issues for Representative David Skaggs of Colorado until the congressman retired in 1998, and he then worked in the solicitor's office of the Department of Interior through 2002. In private practice, Carr specialized in litigation involving NEPA, the Clean Air Act, and the Clean Water Act, and he's been with the Senate Energy Committee since 2004. And I might add that also Mike is a real expert on the clean energy deployment administration idea and has been one of the sort of real champions on the Hill of clean energy over the past several years, and I've gotten to know him and appreciate his expertise in this area. So here's how we're going to do things. As I mentioned, Jed didn't make it today. That's sort of a good news, bad news, I guess. The bad news is he's not here. The good news is that I get to talk longer. I guess from your perspective, that might all be bad news. But anyway, I'm going to chat for about 15 or 20 minutes about where I see things going in the clean energy sector. Then each of our panelists are going to chat for about, say, 10, 15 minutes as well. I don't think any of them brought presentations, but they're just going to talk informally. And then we're going to do Q&A. And then I certainly invite all of your thoughts and questions and input as we go towards the end of this session. I think there's a lot to cover, so we're looking forward to it. So first, just who we are. I'm with Bloomberg New Energy Finance. We're a global research firm focused explicitly and exclusively on the clean energy sector. We have 200 analysts around the world in 13 countries. We've actually written a report with the United Nations on several occasions about investment in this sector. And so that's what brings me here today. In terms of what I'm going to cover in my comments, first I want to talk a little bit about where things stand globally in the clean energy sector, the general dynamics that we see. Second, I'm going to give a little bit of a policy primer, essentially a glossary of terms, and this is really for those of you from overseas or not familiar with the U.S. market in particular and the particular unusual ways in which we subsidize our clean energy industry. And then finally, building off that, I'll talk a little bit about where we see the North American clean energy industry today, and then I'll hand it over to my esteemed panelists here. So first, a look at where we are in terms of investment today in the clean energy sector. What you're looking at here is the quarterly investment totals of new capital invested in the clean energy sector, primarily from private sources, not public sources, private sources. And you can see quarter to quarter, there's clearly been some ups and downs, but more ups than downs. Q1 of 2009 represents the sort of the toughest part of the financial crisis, and then we see a bounce back, coming back all the way through Q4 2010, which was the best quarter we ever recorded for new money. And then this past quarter, which was an interesting one, where about $45 billion in new capital came into the sector. While this is private capital, a lot of that was driven by support from the public sector or from quasi-public agencies and multilateral development banks, which I'll talk about in just a moment. That was sort of the good news. The bad news is that the way in which the sector is being perceived by investors is, frankly, quite negative these days. This is a look at what's called the NEX, which is an index that we run of 95 clean energy companies traded globally. And as you can see, all the way up until sometime in 2008, these stocks were among the hottest in the world in terms of performance. You can see this incredible appreciation. But then you saw this happen as we went into the financial crisis, and clean energy companies and stock prices corrected very, very strongly downward, along with others. And then this, a little bit of a rebound, and then this, and then most recently this. And in fact, the NEX just this last quarter lost about a third of its value over a 3-month period, a very difficult and bad performance for the sector overall. Now, obviously, these have not been easy times in the markets globally, but in particular, there seems to be a good deal of negative sentiment towards the clean energy sector among investors. Just to give you a sense of comparison, this is the Amex oil index, the NASDAQ, and the S&P 500. Less volatility pretty much among all of them, although some interesting similarities between the NEX and the oil index. And you can see on an annual growth basis, all the way back to 2003, now you're just looking at about a 3.4% compound annual growth rate for the NEX. Not spectacular. So what's keeping the industry going? Why did $45 billion go in last quarter, even as investors were getting more and more negative about the sector? One of the biggest factors has been the global stimulus commitments from governments around the world, which in many cases require matching funds from private sector or leveraged private sector investment. And by our count, there's been about $194 billion that was put on the table around the beginning of 2009 to support this sector. And you can see how the money's gone out the door. It obviously didn't all get out right at the sort of height of the financial crisis and the difficulty with the economy, but has taken place over time. And so this money has very much supported the industry. But as you can see, we're heading towards the end of the road here. And this is something that concerns investors. And of course, we're in an era of fiscal austerity here in Washington, as well as in other capitals around the world. And so there are real legitimate questions about whether or not there's going to be this continued level of support for the clean energy industry going forward. One sort of, I would say, somewhat unsung hero of investment in the sector has been the involvement of development banks. And I present this slide since I know this is an international community. You might find this interesting, that this is the amount of project finance that we've counted of the various development banks around the world. And development banks continue to play a very important role in this sector, in particular because the industry is very rapidly diversifying away from what had been primarily, say, half a dozen markets in Western Europe and the United States and Canada into many other new countries in the developing world. And this is where these development banks can really play a role. All right, so now on to sort of the look at the actual industry dynamics. This is a chart that some of you may be familiar with. This is the price of silicon used in a typical photovoltaic module. Back in 2008 or so, we saw an all-time high up over $450 per kilogram for highly processed polysilicon. Then we saw this very sharp decline, which we've not seen come back. And what in effect was going on is that at the height of this price spike, there was a great demand for PV equipment in order to exploit various Western European subsidies. And then all of a sudden, a ton of new capacity has come online, and more to come soon. And we've seen a real breakage in this bottleneck, and that has driven down the price of photovoltaics very, very dramatically. That and the fact that the technology is very rapidly improving at the same time. I'm not going to go through every last bit of this, but one thing I just want to point out, and something I think is always useful for grounding a discussion of renewables and their role in power generation, in most cases, clean energy is not competitive without subsidies with fossil fuels on a pure generation basis. This is a look at the levelized cost of energy, and different people do this in different ways, but the way we do it is we say, hey, if you're an equity investor and you wanted to build a wind project or a geothermal project, how much would you have to sell your power for in order to earn a 10% return on investment if you stripped away all the subsidies? If you're doing this in a world, it's all apples to apples. And so what you can see is that down here you can see coal-fired generation, natural gas generation. This is at the left, down around $50, $60 per megawatt hour, which would be the typical contract you'd have to sign. And as you work your way up, you can see these different technologies. And one of the interesting things in particular are the green numbers I would call your attention to. We've seen really a dramatic shift. This is just quarter to quarter, but over a much longer period, we've seen a dramatic shift right to left in the cost of PV. Wind prices have come down as well. So a lot of these technologies are getting more competitive very rapidly, but there's still a gap. And I think it's important that the industry recognize that in many cases, you need those subsidies to get over the hump. In some parts of the world, particularly sunny parts of the world, particularly windy parts of the world, places with high electricity prices, the gap doesn't exist, and clean energy competes and beats fossil generation, but not anywhere, not everywhere at this point by any means. So in terms of that chart I showed earlier, one of the things that we've noted is that the price of a final cost of a PV module, a photovoltaic module for this year, has dropped about 35-40%, and dropped a lot more than that over the last several years. Again, it is rather astounding how quickly prices are cratering in this sector, and it's having major repercussions. It is also making investors fairly negative and cynical about the perspective for a number of these PV companies, because they see the margins on a number of them disappear, and this is why solar companies and the stock prices have been taking such a beating. This is just a look at the actual margins earned by those who make silicon, either in China or, as we call it, international, which means outside of China, or for those who produce wafers. And what you can basically see is that the margins have essentially gone negative in some parts of the value chain, which is obviously unsustainable. Companies don't produce their equipment very long if they're actually losing money for each unit that they produce. They pretty quickly stop producing. And so we have seen some bankruptcies, and we'll probably see some more in coming months. So that's all the bad news. A glass of water before I give you some good news here. So in terms of the long run, and the real question I think for renewables is the long run, and the question of truly being cost competitive without subsidies, the news looks quite good, actually, particularly for photovoltaics. So here's a look right now at the 2010 levelized cost of energy as we see it for photovoltaics. So if you go back a few slides, what you'd have to sell your power for, what kind of a contract you'd have to sign in order to earn a 10% return on investment. And along the left-hand axis over here, you can see prices per kilowatt hour, different prices of retail electricity, at the residential level, so 10 cents a kilowatt hour up to 70 cents a kilowatt hour. And then along here is kilowatt hour per kilowatt per year, which is essentially a measurement of how much sun, how sunny where you live is, left to right. So right now, given the current costs, these markets, essentially, you could build a PV system and earn an appropriate return as an owner of about 10% without the subsidies in place. These are markets where things are already in play. Obviously, these are relatively small markets, but they are markets nonetheless. If you fast forward to where we predict the price of PV is going to fall to, you start to see a lot more countries, big, very interesting countries, and, of course, California, start to come into play as realistic markets. And you may say, well, Germany's already installing all kinds of stuff. You're right, they are. But they're also being subsidized like crazy at the moment, and that's driving a lot of that market. So if you look at a few other places, you can see, interestingly enough, China, though it is the number one manufacturer of PV by far, we don't necessarily view as becoming sort of a market driven by economics domestically, where they install a lot of PV really anytime, particularly soon. So what all that PV, what's been driven, those dynamics of PV are a large amount of oversupply and under demand. And this actually similar story in wind as well globally right now. You can see that we predict about 80,000 megawatts of potential capacity in manufacturing globally by 2014, and somewhere in the neighborhood of, let's say, about 50,000 megawatts or 50 gigawatts of demand by that year. So you're looking at massive oversupply or overcapacity in this industry. But even right now, it's pretty substantial as well. And what this is being driven by has been the massive ramp up in China of new manufacturing capacity. And this, again, is making investors fairly negative about the sector. It's also driving down the price of wind turbines, and this is a survey that we do among buyers and sellers, and you can see quarter to quarter the price of a wind turbine has been dropping, and we do think that's ultimately good news because that's making wind more cost competitive with its fossil competitors. All right, now I'm going to take just a quick moment before we move on and talk about a few key policies in the U.S. and what they are. So those of you who know all this stuff, now's a good time to check your BlackBerry. Everybody else, hopefully you'll stay tuned here for just a moment. The key policies that have spurred clean energy development in the United States over the last several years. First is the 1603 grant program, which is also known as the so-called Treasury Grant Program. It was established by the stimulus program, the stimulus bill in February of 2009. And what it does is it gives developers of projects a cash grant representing 30% of their project's value. So if I show up and I'm building a $100 million wind farm and I've just brought it online, I show up at the Treasury, I show proof that I'm online, and they quite literally almost hand me a check for $30 million. And that's the subsidy. That's been in place since about the middle of 2009, in fact, and it starts to actually sunset at the end of this year. It has been critical in sustaining investment in clean energy in the United States over the past 2 years, and it is viewed as potentially vital going forward. The next one is the production tax credit, which is essentially a tax mechanism to subsidize the clean energy industry. It supports primarily wind, though it can be used for other technologies as well. And it gives developers 21 cents per each kilowatt hour of power that they generate. And in theory, that gives them a motivation to build projects that are the most productive because they can receive the most amount of tax credits. But because a lot of these developers are small and don't actually pay taxes because they don't make money, at least to start with, they can't use these tax credits, and they need to go out to big financial institutions like some of the gentlemen here and secure some help in the form of so-called third-party tax equity investment. And those third-party investors get the benefit of the tax credit. The PTC has been critical also for development of wind in the U.S., and it is due to expire at the end of next year, and that is very worrisome, I think, to a lot in the industry as well. Next to the 1705 loan guarantees, anybody who caught the last session may have heard a little bit about them. Anybody who's been reading the paper about Solyndra knows a little bit about the 1705 loan guarantee program. And essentially, it's the federal government, in the form of the Department of Energy, guaranteeing debt that gets issued to various manufacturing and power generation projects. 28 guarantees were issued by the program before it more or less wound down at the end of September, representing about $16 billion. I always find these guarantees fascinating because it's a guarantee, and yet what they're actually doing in most cases is the DOE is guaranteeing a loan that's actually made by something called the Federal Financing Bank, which is at the U.S. Treasury Department. So essentially, it's the federal government making loans to projects in the United States. It's really at the bottom line. Next, on the bottom left, the Clean Energy Deployment Administration. This is a very interesting idea of a so-called, some have called it the Green Bank, or I know there are multiple ideas out there for this, but for some kind of a self-sustaining agency that receives some federal funding but then makes loans to clean energy projects and companies to try and develop new demonstration scale projects and new technologies, in effect. And it, unfortunately, has not been brought into law, unfortunately for the industry, although it was included in some previous versions of some major energy legislation that eventually didn't pass. And Mike really is an expert on that and can talk a bit more about it. There are renewable portfolio standards. Those are state-level policies that mandate certain amounts of clean energy be brought online year on year. There are about 30 of those in the United States in different states. And then there's a similar sort of companion idea of a national renewable electricity standard, which would say at the federal level, we would mandate certain amounts of clean energy year on year that would have to be added nationally. This exists in other countries around the world, in Europe, but we've never made such a commitment at the federal level in the U.S. So hopefully you guys are still with me after that, but we're going to talk now here a little bit, just before I wrap up, about where we see the North America outlook specifically. This is a look at the number of actual, the bars represent the number of actual gigawatts of capacity that have been added in the United States year on year. And you can see that the high, which was up here, that's 10, was about 10 gigawatts installed in 2009. That was an all-time high, and we don't, in our forecast, as you can see, don't anticipate the market returning to those heady days anytime soon. Just to put that in context, China put in place 17 gigawatts of new capacity in 2010, which is certainly the all-time leader in terms of the most ever put in. And the line represents the amount of actual capital that's been deployed, and you can see a bit of an up and down pattern that somewhat mirrors the next year's installations in new wind capacity. The 2011 numbers a little low, in part because it doesn't reflect, frankly, the third quarter, and we're going to have obviously more that takes place in the fourth quarter as well. But it bounces up and down along with the industry. Again, we're looking at an oversupply situation in the United States, which should put pressure on prices of wind turbines and help keep them low. The dotted line represents what we view as U.S. demand, and this is supply from different manufacturers. I think it's interesting to note that 2008 and 2009, there was a significant amount of turbines that had to be imported into the United States in order to meet demand, and that situation flip-flopped basically last year and into this year, and that we perceive that as likely to continue. One of the questions I think we're going to talk about is where wind stacks up versus natural gas in the United States. For those of you who are here and live here, you've probably been reading the stories about these incredible so-called discoveries of new natural gas reserves and the new techniques of getting natural gas out of the ground. From our perspective, more importantly, we've been seeing natural gas hover around $3.50 to $4 per million BTU over the last year or two, which is very low by historical standards. And the implication on that is that for any local utility, the question is, do you buy power from a new natural gas plant or from a wind plant? That's often the kind of decisions that have to be made. And for local officials, public utilities commissioners, the decision is which kind of a plant do you greenlight for development in your backyard. So what this chart shows, just in some detail, is based on the actual power purchase agreements signed by wind projects. And you can see that they've been rising more or less up to about $70, actually maybe a little bit higher here, per megawatt hour has been the contract signs. And here represents what's actually going on in the market in terms of the price of electricity. And as the economy has been slow, not too surprisingly, demand for electricity has not been growing, and the price of electricity has dropped. So essentially, you're looking at wind being sold at above the market price. And this is something that a lot of local regulators are confronting, and this is a real challenge for wind in the United States at the moment. I'm going to just make one quick comment on Canada, and we're going to have some real good expert commentary from Rob Nicholson in just a few moments about Canada as well. But Canada is an interesting market. It's obviously much smaller, but there's a lot of growth potential there as well. We stack projects up by announced, permitted, and financed, and you can see that we expect things to more or less stay leveled around 2 gigawatts over the next several years. But of course, that's assuming that these projects that are announced get financed and come to fruition. And again, hopefully Rob can shed some light on that. One point I would like to make, just if I could, is that we've seen interesting variations in the cost of solar in different markets around the world. For different places, different costs, and you can see this top line right here shows that the average system cost for California right now is $6.40 per installed watt, whereas the average system cost for Germany for a small-scale system of under a kilowatt is about $3 a megawatt, and the price right now at the factory gate for a solar module is about $1.30 a megawatt. One of the interesting questions that I always wonder about at the U.S. market, and we haven't, sort of my colleagues and I haven't figured out, is why is it so unbelievably expensive right now to do solar in the United States compared to doing it in Germany? I don't really have the answer to that question, but to me, it suggests that if global factors come into play, we will see U.S. prices start to come down because there's clearly, it's a global market with a lot of trading that goes on. This isn't sustainable. And that's a bit of a good news, bad news story. I think the sort of good news is that as those prices come down, it's going to allow for a lot more development of projects in the United States as this stuff becomes more economically viable. The bad news, obviously, is for some manufacturers who may not be able to compete at these lower prices. Just last two slides and two comments here about PV in the United States. And I should say that all my comments here have been about solar and about wind. And obviously, our firm thinks a lot about geothermal, about biomass, about biofuels, these other areas as well. I have focused my comments here today because this is really where the vast majority of money has been going over the last couple of years, but certainly during Q&A, happy to take any questions on other technologies as well. But this is just to give you a sense as to how difficult it is to predict what's going to happen with PV based on what we know. This is a conservative perspective, which is about 1.5 gigawatts expectation for this year, and then this is the, let's see if I can do it, the more liberal or the more optimistic perspective, which is 1.8. But the variance between what we think could happen in 2013 is very large, and potentially you could see a 5 gigawatt market here by then. There's a lot to play for and a lot really to be determined at this point. So anyway, with that as my last slide, I'm going to hand it over right now to Rob Nicholson, who's the Managing Director for Power and Utilities Finance at the Royal Bank of Canada, and I look forward to his comments on what's happening north of the border, as they say. But then I also certainly look forward to your questions once we're done. Thanks.
Well, great. Listen, I'm gonna stay right here because I've been given 3 to 5 minutes to talk to you a little bit about what's going on. So rather than transition, I think it's probably best if I just stay put. I think a couple of things I'd like to just put in context for you so you understand. First, I would say, if I'm guessing at what you want to hear today, this is for you to ask us as many questions as you can. It's pretty open book from my perspective, so whatever question you have, I'm absolutely happy to try and answer if I have one for you. So I would encourage you to do that. And second of all, I would just sort of say that I think the panel up here, what we've tried to construct is I, to some extent, represent the bank market. So while I worked for a Canadian institution, I've worked for international institutions in my career, and I'm happy to talk about the bank market in general. John really represents more the bond market. He actually works for a life insurance company, but they tend to be the main investors in the bond market. So think of those as two different financing markets, I would just sort of say. So keep that in mind, both in terms of my comments and John's comments. I think I'm going to start off with describing a little bit of the power system in Canada, because it differentiates very significantly from many other places in the world. And primarily that's because we're a little bit old-fashioned, almost. If you take a walk across Canada, most of our utilities are provincially owned. There are a few that are owned by private enterprise, but I would say fundamentally we have a utility in each province. And again, there's always exceptions to that rule, but that's fundamentally correct. And what that really means for a power developer is that they have an opportunity to have a contract with a highly rated entity, either A or AA rated kind of credit enterprises, because typically the provincial utility has some kind of connection to taxation, and effectively their credit rating is extremely high. So again, there's always exceptions to the rule, but fundamentally across the country in Canada, we have a contractual arrangement. Typically the utility will source a 20-year PPA with a developer, and basically that developer will do what they need to do to get the project put up in place, but fundamentally they know they have a contract, which typically is take or pay. So if they generate the electricity, the utility will take it, and they'll know what that price is for the next 20 years. So it's a very bankable contract from a credit perspective. The exception, of course, is Alberta, which is a merchant market, much like in the United States you'd find in the Northeast, New York, PJM, or California, Texas. But that's the exception of the rule. The other exception is in Ontario, we have a FIT program. So modeled after many of the European programs, one whereby there's been a price posted for either wind or biomass or solar energy. And again, depending upon the size of the project, you have a different tariff. But the concept there is, instead of having the volatility associated with an RFP process, which may occur every 2 years or 5 years or whenever, that you now, as a developer, have a posted price that if you can build a project and you can make money, then you can go forth and prosper. So that's sort of the framework of what we as financiers face, I would say. So keep it in mind. It is fundamentally, we are looking at long-term contracts. to finance. So it's classic project finance in the truest sense of the word. If you look who participates in the bank market in Canada, it tends to be, in Canada there are fundamentally 5 banks, and lots of people will argue with that, but fundamentally there's 5 what we call Schedule A banks. And about, 3 or 4 of them actually are active in the non-recourse project finance world. So understand that, it's not everybody. Not everybody perceives that as a risk they want to take on. Not everybody perceives that as an expertise they want to build. But fundamentally, there is a fairly healthy market out there. Obviously, we could never finance all the projects we want or we have to build as a country if there were only 3 or 5 of us participating. So there's a lot of outsiders that come in. They tend to be, and again, this is in the non-recourse project finance world, they tend to be either European or Japanese. And it's a gross generalization, but it's fundamentally true. The American banks, American institutions left the industry in the 2000-2001 timeframe, and I know that because I lived that experience. I worked for 10 years in the U.S. as a banker and worked for one of those organizations, and as a project finance group, we were 150 people worldwide, and we were summarily dismissed one day. So I understand what happened to the U.S. industry as far as project finance is concerned. But if you look at if we sort of start to get into the details of what people are prepared to take on as risks, remember that we almost have the perfect situation to finance. We have highly rated entities as the off-taker. We typically have technologies that are fairly well established. Yes, some are newer than others, but fundamentally they're all bankable technologies. And the Canadian banks will typically finance what we would describe as a mini-perm. So it's mini permanent financing is what the acronym actually means. And really what we'll do is if you assume we have a 20-year contract for an off-taker, we will finance the construction of the project plus some kind of tenor, and that tenor is typically 5 years. So the amortization of the loan would be over a 20-year time frame. So we would amortize. We're not asking you to pay off the loan in 5 years. But what you face at the end of the term of the loan is a refinancing event. And our view from a risk perspective is that I don't know what's going to happen 15 years from now. I don't really know what's going to happen 5 years from now. But I'm closer to being able to evaluate the risk over the next 7 or 5 years than I am over the next 15 or 20. So I will lend you money for, again, 7 to 9 years. But you need to come back and talk to me. And potentially I'll refinance the project again, but we need to have a conversation. I'm not going to give you the money for the next 15 years. And that is very true amongst all the Canadian banks. And it's primarily driven by 2 reasons. One is we're regulated differently than many other institutions. And fundamentally, our cost of capital goes up tremendously with duration of a loan. And what I mean by that is each piece of capital we set against a loan depends upon the credit quality of that loan, a number of fundamental factors, but primarily against the credit quality of the loan and the duration of that loan. So as that loan gets longer, i.e. beyond 5 years, we basically become uneconomic because the percentage of equity we have to put against that debt is much greater. So that's one reason. The second reason is more what I described as just, frankly, the Canadian appetite for risk. We believe that we should have a conversation, that we all don't know what's going to happen over the next 20 years, but we're quite happy to lend you money based upon you financing it over 20 years, but we have to talk in the interim. And so if you think about that, that's really our proposition. Now, I will say the European banks and the Japanese banks that participate in our market in Canada don't necessarily have that same view. They are quite prepared to go with the longer-term debt. So typical financing would be on a 20-year contract. You might get 18-year money. So they would want some kind of tail, 2 years of tail at the end of that contract, just in case something happened. And they're successful in that market. But the Canadian banks have basically washed their hand of that and said, that's fine. That's a risk profile you like. We don't like it. Again, not just because of risk, but because how we're regulated. And we do see, frankly, particularly in 2008, we saw a number of those both Japanese and European institutions exit our market, primarily because I think their home country said, no, we're going to preserve our capital for our own institutions rather than for some Canadian project, which again is fair enough. That's the world of capitalism. Capital is very mobile. I would also say that just fundamentally in today's world, doesn't matter whether you're talking about an equity investor or a debt investor, there is an excess of capital available for good projects. So make no bones or mistakes about this. There is an excess of capital willing to be invested at a reasonable rate of return with a risk profile that we describe. Now, that all being said, what we often find is people come to us looking for debt that don't really have all of the makings of the project yet, and we often work with them to get there. But I want to leave the audience understanding that there is more than enough capital between the bond market and the bank market to finance any project that's out there, provided it has the right risk-return profile for everybody to be happy with. So that's kind of a quick snapshot of Canada. I'm going to flip to the U.S. now and just talk for a minute about the bank market in the U.S. Fundamentally, it's quite similar, I would say, to the Canadian market. Again, multitude of different participants, much bigger market, obviously, more than 10 times the size. Not more than 10 times the number of institutions, but certainly capital deployed much more than 10 times the size. You still get the same dynamics. The U.S. banks not participating in the non-recourse project space, but really the market being dominated by the Europeans and the Japanese. Again, various different themes on how long a tenor they would take, but again, assume it's fairly similar to the Canadian situation in that the international banks will tend to be prepared to take a longer view of things. The big difference in the United States is the fundamental differences of the credit quality. Again, you don't typically have a situation where you always have a long-term contract. Many of the markets in the United States are merchant, or many of, frankly, the utilities are not as creditworthy, not because they're inferior, but just because of the way they're either financed or because they're not necessarily tied, their owner isn't necessarily a provincial enterprise or a state enterprise. So they have a different risk profile. So the financing's a little different. In the United States, there are two other markets on the shorter tenor that probably people should think about when they think about financing. There's a very active high yield market. It tends to come and go. High yield, by definition, means sub-investment grade. And so you're dealing with higher risk credits, more expensive credits. But those markets can be very, very active. The other market is what we call a term loan B market. And a term loan B market is basically a market in the bank world. But instead of amortizing a loan over a 20-year time frame, basically what happens is the bank sweeps all the cash coming out of the project. And so that is really for projects that are already built as opposed to a project under construction, or for situations where people have acquired a project through an M&A process. So it's not for building anything new. But again, I just point out that there are a multitude of different places to go to financing. There's a multitude of different risk profiles within those different markets. And all of them, the more risky markets, so the term loan B market and the high yield market, very much depend upon whether it's 2008 or 2010 or 2011, but they do open and close from time to time. The project finance market tends to be more stable than any other finance market. Again, because you tend to be financing very high quality opportunities over long periods of time. So with that, I'm going to turn it over to John, and he's going to talk a little bit about the bond market.
Okay, thank you, Rob. That's an excellent overview. Just to give you some introduction, I'm in the corporate finance group of John Hancock in Boston, and we're part of the Manulife Corporation. Manulife is a Toronto-based life insurer, and our business breaks down globally as roughly 1/3 Canada, 1/3 U.S., 1/3 East Asia, and I work in the U.S. business. And we are an active investor in the bond markets, both the public bond markets and the private bond markets. In our renewable portfolio, it's about $3 billion today. That includes wind, solar, biomass, landfill gas, also a significant energy efficiency portfolio where we've invested. If you look at what we've done, most recently we've participated in some of the stimulus programs over the last few years. One was a Build America bond program providing capital into municipalities when the tax-exempt market froze up. Another program more relevant to this audience was the Department of Energy's loan guarantee program. Ethan mentioned that there was a fairly well-known full guarantee program for innovative technologies. There was also a side program, another part of that effort, that was for proven technologies, where only 80% of the loan was guaranteed. And we were an active participant in that, committing more than $800 million into a number of projects that were participating in that program. The idea there is that a commercial lender would be at risk for 20% of the loan, and that would help provide a risk protection to the government, that they were making prudent extensions of credit. And then we would price the loan reflecting the fact that 80% was government guaranteed and offer a lower cost of capital to the project. So that's sort of what we've been up to recently. I would comment that our portfolio within the power industry is, our power and infrastructure portfolio is about $17 billion, and we're an active lender both on the project finance side, as Rob described, and on the electric utility side. So we see both the individual renewable power plants being built, and then and we also see the companies that are buying that power, and we participate in industry organizations on both sides of that. So we're a member of the American Council on Renewable Energy, and interact with renewable energy companies there. We're also a participant in the Edison Electric Institute, which is, if you will, the trade association for electric utilities, and I've participated in roundtables with state commissioners, helping them appreciate what drives financing in the United States. And I would echo Rob's point that today, for well-structured power projects, it's not a capital-constrained market. The bond market will readily do today 20 and 25-year financings for power projects, renewable energy projects that have a 20 or 25-year contract with the local utility to buy their power. We've seen those deals come in the last year, and they were well subscribed by a number of investors. Cost of capital is pretty attractive, probably around 6% cost of debt today, and maybe could that go to 6 to 7? That's kind of the range we've seen over the last 12 months. Deals placing at 5 to 6 to 7% debt. You could probably get inside 6 right now just because of where markets are, but pretty reliably 6 to 7 going forward. And I'm hitting on those numbers because in renewable energy, the cost of delivered electricity is dominated by capital costs. To put this in context, for a natural gas-fired power plant, maybe 30% of your cost is fuel, maybe 15% is operating cost, and then maybe 45% or 55% rather, is returning the capital and return on capital for initially building the plant. When you get into renewable energy, that 55% jumps up to 65% to 85% of your delivered cost of electricity is returning capital back to the original investors from building the facility. And so doing what you can to minimize risk and bring in cheap capital has a tremendous impact on delivered cost of electricity. And really that is long-term contracts. And so what we've seen as being the major drivers of successful renewable energy financings in North America, two areas. One, at the federal level, the subsidies that Ethan walked us through that make power more affordable. And then the second level is the state mandates. And people in this audience may or may not be familiar, but the electricity industry in the United States is regulated principally at the state level. And state public utility commissions are the main drivers in resource selections and getting power plants to go forward. A local utility will either say, we want to build a plant here, and the state commission will approve it, or the state commission will say to the utilities, I want more renewable energy in the mix. Please try to get some solar, get some wind, some biomass, whatever it might be. So as you roll down to the state level, the points that Ethan mentioned about the stress that state commissioners are under is one that we see very directly, that as the recession has continued, as unemployment has really stayed stuck at levels that are higher than anyone wants to see. There's more and more discussion about affordability in the conversation with state regulators. So I would echo the point that that's a growing pressure on renewable energy and how much continues to be contracted out. I think those were the main points I wanted to hit for intro. I guess the other thing that we see that you pointed out, Ethan, is the economics of renewables against natural gas in North America are very tough right now. But the economics of renewables versus oil, which in other markets or in Hawaii, Puerto Rico, some other places, a lot more favorable. So I think that's kind of an interesting theme in the industry as well.
Great, thanks so much. Mike, if you would, let us know, give us the perspective, policy perspective on all of this. Obviously, I think a lot of what was either directly mentioned or alluded to in both these gentlemen's comments was that the various policy environment helps to set how attractive a project is, if it's considered creditworthy, and how competitive it is as well.
All right. Well, it's a broad topic. I guess I'll try to give some comments that I think can kind of dovetail nicely with the financing end of things, because I think that's a pretty good lens through which to view what we need to accomplish to broaden deployment of renewables. So, historically, the issue with renewables has been what's the demand growth, and that's sort of the market risk that these guys have to price in when they're looking to finance a new project. And the United States has had, in gross, sort of leveling off demand growth for electricity, really for over the last decade, and maybe a little bit longer. It obviously tracks a little bit with just sort of the overall economy, but we have a fairly built-out system. We have a robust generating capacity in the United States, and importantly, from this perspective, we actually have a fairly inefficient system in many ways. And so people hear frequently about in the McKinsey study and other studies about how are we going to reduce greenhouse gas emissions over the longer term, about the low-hanging fruit of efficiency. Well, that's good news from the perspective of there's actually a lot of cheap ways to reduce how much greenhouse gas we're producing and still get the same economic output. But for renewables, which are really the important part of the equation, if we're going to get down to zero, which has to be the end goal, it's actually a problem, because now it's, in one perspective, it's just another energy source that you're competing with over the long term. And so I think that's where you see a lot of the recent projections out of the Energy Information Agency or others about fairly level demand growth in the United States, because there's so many opportunities to inefficiency to kind of to squeeze that out of the system first. So I think the challenge that people grapple with is how do we where does that demand growth come from? Where does the draw for the renewables come from? When we talked a few years ago about pricing carbon or renewable electricity standard, those are all sort of gross demand drivers that would have squeezed some of the least efficient, more carbon intensive generating capacity out of the system, and then that would have provided that space for the renewables to take it up. Political dynamics have shifted pretty dramatically over the last few years, making, again, those gross drivers, things like pricing of carbon, much more unlikely in the very near term. And it's also taken down with it, or taken down the probabilities of things like renewable electricity standard or or the like at the federal level. At least in the very, very near term. I don't think I'd be shocking anyone to say that it's very hard to see renewable electricity standard being adopted at the federal level in this Congress. We have been working for some time on a clean electricity standard, which is a sort of a variation on the renewable electricity standard that we use some kind of a carbon-based metric to measure the relative values of electricity. It sort of serves as a bit of a proxy for a price on carbon, depending on how you want to look at it. It allows things like natural gas into the system, but then that leads you to sort of the next problem, which is that natural gas has fallen in price so dramatically that and natural gas was already very attractive to utilities. I think it's sort of an important point to make that from the perspective of a utility, a natural gas plant is relatively cheap, very quick to bring online, and is actually very compatible with their existing systems. They're easy to spin up, they're easy to spin down. They're sort of a nice asset to have, and so utilities generally will tend to go to that at the first resort if fuel prices aren't too high, and fuel prices really aren't right now. So these are all sort of I think that's the general market constraints that are in place that are kind of that provide the headwinds for new renewable capacity going in. There are, of course, other social factors that are continuing to drive it forward. I mean, there are regional desires in particular. State-based renewable portfolio standards have remained mostly in place. There's been a retreat in a few different places, but due to price pressures. But in general, there is still a fairly robust market just from the renewable portfolio standards in the states. And I think that's probably the main demand driver that we can foresee for the next couple of years. Then the other part of the equation, though, that I think we spend a lot of our time thinking about is, that's sort of the demand side. We've tried and we've had some success, but have a long way to go in generating more demand. But on the sort of the supply side of the equation, if you will, the other part of this is on a lot of Ethan's graphs, you can see that these prices are coming down as scale begins to take over in PVs or wind. When you get a lot of and a lot of that is also technological innovation as the next generations of these products, whether it's PV or whether it's wind turbines, come out. They're higher efficiency, they're at higher capacity, the factories themselves, just through economies of scale, are able to turn them out at a much cheaper price. I think the general sense in Congress has been that we need to get to the next generations faster in the United States to compete with a lot of our overseas competitors like China or Germany, who are competing in large measure on scale. They're pushing a lot of money into their manufacturing sector and into these systems to achieve economies of scale as quickly as possible. I think the United States pathway has typically been to try to out-innovate, to try to leapfrog over the innovation cycles and get to achieve a scale at the next sort of innovation point so that we can compete. And so that's been our very recent focus, particularly in the committee, particularly with my boss, with things like the Clean Energy Deployment Administration, which was aimed squarely at circumnavigating sort of this valley of death of where a new technology is not yet bankable as for these guys. Where the technology may be produced by a manufacturer who typically would have to give a 15, 20-year product lifetime warranty to a developer. Well, that's not worth that's not worth much if the company itself has a balance sheet that's a third the size of the actual project that they're financing. And so you do have these gaps where the technologies are not commercially proven. I think everybody can look at them and say, well, yes, this does work, but they haven't proven themselves in the commercial marketplace, or the balance sheet of the supplier isn't big enough to match up, to allow them to be bankable in the traditional sense. And so we've been trying to provide sort of lubricants to the system so that these projects can be bankable. And that's ranged from loan guarantees to specific tax credits that either go to the manufacturer and can lower their costs going in, that things like the investment tax credit. PTC is sort of a hybrid system, whether it's sort of arguable whether that's a demand driver or whether that's sort of increases the bankability of projects. These sort of targeted approaches have been where we've achieved the most success recently. Not to get into it too deeply, but I think there's been Solyndra is sort of a symptom of the growing skepticism among a certain contingent of Congress with the idea of providing that transition to, there are those who feel like they don't really see the end point for these technologies. They don't see how these are ever going to become commercially viable. And then there are those who simply, have other priorities. But, there has been a bit of a confluence of these kind of folks in recent months, in recent years, that have made the environment, even for these more targeted approaches, which we've traditionally been able to do, that have made those even less likely. We remain optimistic. We have had and still maintain bipartisan support for things like the production tax credit, for the investment tax credit, for Clean Energy Deployment Administration. Each of those have been bipartisan proposals. A lot of it is caught up in sort of the politics of the moment. So I'm not sure how much you can really take away from what's going on right now as to what's possible once we get through another election cycle, once we get a sort of a firmer idea of where the economy is headed and where frankly the voting populace wants the country to go. I think that'll be the biggest factor that'll clarify things. I do think that over the medium term, though, one of the big issues is going to be kind of understanding the real-world consequences of turning off some of these programs. We are at the point where the 1603 program ends at the end of this year. 1603, by the way, is not a distinct program in a lot of ways. It's really just a mechanism for making the tax credits work. So the investment tax credit and even the production tax credit, particularly during the as Ethan was mentioning, those require a third-party intervention, somebody with so-called tax appetite to actually monetize those. And frankly, nobody had tax liability for a couple of years there, and so there was no tax equity market. There's also just a broader question over the long term. Does it make sense to have, to do this through the tax code, to have the need for essentially a passive investor to move into each of these projects to soak up tax credits that the actual developer or the actual manufacturer can't use? 1603 just turns that into a grant and says, here's your cash. That's more efficient in many ways, but it's also much more difficult to administer over the long term. It's very hard to turn that into a long-term program because, frankly, you're cutting checks to successful companies, and sometimes, like in the Solyndra case, an unsuccessful company. And we can sort of see the political peril that's inherent there. So PTC ends at the end of next year. That's actually the placed-in-service date. So effectively, if that's not renewed, or if there isn't a pretty clear sightline that's going to get renewed by the end of this year, you won't see any new wind projects going on after about the end of this year because there just won't be enough time to plan them and get them in the ground. And ITC was extended, the solar ITC was extended, I think, to 2016 at the moment. So that's more or less okay, but those are, again, longer lived. Those assets take a while to bring online. So it's, we are facing, I think, a decision point coming up pretty quickly about whether or not we care, frankly, if we're major manufacturers of these products. I think, from my boss's perspective, from the committee's perspective, we see a multi-trillion-dollar global market in renewable energy. Notwithstanding the sort of flat demand growth in the United States, demand growth in the rest of the developing world in particular is incredible, and I think it's generally thought of as pretty unlikely that they're going to replicate our system. They're probably not going to go with large central station pulverized coal generation in much of Africa, let's say. So, I think there are tremendous opportunities out there in the rest of the world, and we hear quite frequently from companies saying, this is where we want to locate in the United States, and we'd love to sell our product in the United States, but our long-term goal is we're going to be a dominant player in PVs, selling to the rest of the world. So they need help to get to that point, and we think that sort of that competitiveness aspect of things, particularly the supply chain associated with these very these hard assets, is a really important and I think somewhat overlooked aspect of the sort of the policymaking landscape that we're trying to address right now. But we're at a decision point. I think we're going to find out in fairly short order. Is the United States sort of committed to continuing to be a player in this? Are we committed to pushing the innovation pipeline to the point that we can continue to lead in some of these industries? Some of these industries have already started to fall behind. Or are we kind of willing? I think my boss had said it. We're willing to go the way of the flat screen TV. Where basically all that capacity just moved overseas, and the next iterations, of beyond plasma into LCD and LED. That's all. No one even sort of talks about the United States as a potential player there. So I think, leaving it that, on that potentially down note, I think that's where we are. I think that's the way we're looking at the world right now.
All right. Well, thanks for that sunny outlook, Mike, on the state of U.S. renewables, and I think it raises real questions about where we're going, and I certainly want to come back to you on a few things. I will, though, I think we'll do about 10 minutes of questions, and then everybody prepare yours from the floor. But I'm struck by first two things that John and Rob had to say. One, you were mentioning that projects that are, that there's no shortage of supply of capital for so-called good projects that are bankable. And John, you were mentioning that clean energy projects, as we know, are highly, highly sensitive. Their economics are highly sensitive to the cost of capital.
Right.
I guess I'm just going to juxtapose those two comments and let you discuss, if you could, a little bit. Because to me the question is, if we have a policy change-up, are there so-called good projects that you would be interested in next year? How much is policy, contingent on defining what is a good project for you to look at? And then also, of course, for you, John, how much does it change the cost of capital very directly in terms of what policies are out there?
Sure. So for us, I think, the definition of good project is very subjective, but in the financial community, it has pretty well-defined lines. And I think, if I look at Canada, we would argue we don't have subsidies, which is true, but it's not, because what we do is we set a policy. A provincial utility will set a policy that I want 10% or 20% or 30% renewable in my province, and as a result, I'm going to go procure that. And by definition, I procure it under a competitive environment, but there's no question that I'm procuring it at a higher rate than I would be if I were building a gas-fired plant. The biggest threat to renewables today is $4 an MMBTU gas. There's no question that that's the biggest risk to renewables today, and certainly in this country and in Canada. You don't have that in other countries. Other countries are not necessarily so gas-rich that we are here, or But that's what North America faces. And so I would say, there are things that policy can do. Policy, the biggest issue for us, I would say, as financiers for policy, is clarity of policy. Our goal in life is, or our job in life is to measure risk and to get commensurate reward for that risk. And the biggest change in policy has massive effect on our measurement of risk. So whether the policy is punitive or whether it's positive, we can deal with that in the risk measurement. But to policymakers, I generally say from day one, try and set your policy, try and make it as positive as you can, and then let it run, and let it run for a long period of time. You're dealing with assets that, we talk about 20 years for a wind park, but candidly, we don't know how long they're going to last. Most gas-fired plants in both this country and Canada are 40 plus years old. So these are long-lived assets, and what we can't have is policy changes in between, or at least I'll call it minimal economic changes to those policies along the way. So my comment on policy is to try and set a logical policy that hopefully is based in economics so that it will have its own natural long life. If you have a policy that has skewed economics, then generally what happens is when you have a political change, you have a change in that policy, and that creates problems for people who are investing on the long term.
I'll give John a sec, but I'm going to jump right to Mike because I want to ask, is that in any way practical request to make of the American political system, given that we change houses of Congress about every 2 years around here these days?
Sure. No, it's not an unreasonable request. I mean, it's not the way we've treated renewables to date. It's interesting to think about it. I mean, the tax credits that we have issued to, oil and gas, production tax credits for getting into areas that the industry has found difficult to do, were from the beginning permanent. There was never any, as far as I know, any discussion of even making them expire at any point. I don't think we've done anything in the renewables context that is permanent. Everything is of some limited term life. And we don't do other tax credits that way. The mortgage interest deduction is a permanent feature. And we've done that over a very, very long term, and we have created an incredibly liquid mortgage finance, mortgage-backed bond industry. So, I mean, it's not unreasonable to do it. I think it is difficult to ask to do something new that way. That's sort of the problem is that, I think there's a lack of context when you ask. I like to think of it if you went back 100 years and said, we're going to build this, in the time of, in the 1900s, and said, we're going to build this grid of wires that's going to carry electricity from coast to coast, and we're going to mine coal. We're going to take the tops off of mountains to pull coal out, and we're going to burn it up, and we're going to boil water, and that's going to generate this electricity for the entire country, and that's going to cost $3-4 trillion. People would have said you're totally insane. But that's sort of what we're asking when you start talking about renewables, is we're going to replace an entirely functional electricity system, and so people looking forward can now have pretty good optics on that cost. They're saying, well, I can see how much that's really going to cost over the near term, and so that's sort of considered a new spending item, and I think that's the biggest challenge. And so kind of putting it into the context of, well, what if we don't? Where does that leave us? What are the actual costs to society? What are the costs? What's it going to cost to seawall Manhattan in 50 years? Those are the kind of things that can maybe rationalize the policy a little bit. But it is hard to get people to look decades off into the future to see the consequences, and then and extrapolate back to a major new directional change today.
John?
On the cost of capital point and policy and the interplay, for sure policy is critical because as investors we're not willing to go at risk for the shifting relative cost of renewables versus natural gas. Your slide illustrated beautifully how volatile that can be. So we need revenue certainty if we're going to make a long-term investment in these long-lived assets. And the big driver there has been at the state level agreements with the state commission and a project that here's a 25 or 20-year commitment to buy your electricity. For us, that just unlocks everything. In the absence of that, if you look at cost of capital for a contracted power plant, at the range of debt costs I was talking about, plus what we'll bid for project equity, you're getting about an 8% cost of your overall capital ballpark. To buy a merchant generating plant, you're looking at all equity, and it's a 20% plus return that an investor would need, and that's in the context of 20 to 30. And so that just gives you one idea of how the market prices that risk of having the revenue certainty versus being at risk of commodity cycles.
Actually, coming back to this issue of the states, I think from an outside perspective, your point's very well taken. People tend to think of the U.S. as one market, and yet we're really 50 individual electricity markets. The
despair of any number of foreign investors.
It is fundamentally, it creates inefficiencies.
Right.
You can't move the best wind power from certain states where nobody lives to certain other states where everybody lives.
But sometimes it's an advantage too, because one of the difficulties I think with the national renewable energy standard is that the economics of the power system in the United States are very different between regions, and so making a standard that the middle of the country is happy with, the East Coast is happy with, and the West Coast is happy with is extraordinarily difficult. What's the advantage of our state-by-state regulatory system is it does allow things to happen more quickly, and you see that, I think, in Texas and some other places. So I guess it's a double-edged sword.
But I do wonder if you tell me what you foresee here, because we've got these 30 state renewable portfolio standards, and as Mike points out, and I agree, they are the baseline driver of demand in the United States, especially given how cheap natural gas is. Are we going to enter a situation where PUCs and commissioners, many of whom are either run for their jobs or are political appointees, where they just aren't going to, they aren't going to approve power purchase agreements for clean energy projects because they just decide that they're too expensive, and they're going to say renewable portfolio standard, be damned.
Yep.
I don't want to take that heat.
I think you're going to see more and more of that, Ethan. Your point's good. About half of the state commissioners in the United States are elected, and about half are appointed. Even in this, what we've seen with any number of programs in terms of how state regulators manage the utilities in their state is that there will be a standard that you're supposed to meet, and as long as you show that you've made best efforts in moving towards that standard, that's usually sufficient. And so as the voter support and concern with renewable seems to be backing off, and they've already got a fair amount deployed. If the utilities and the commission, they're in a position right now where even if they don't meet the standard, they can say, well, we did a lot of good work toward meeting the standard. Not everything showed up, not our fault, but let's go slow on pushing this further. I think that's kind of how it probably evolves, not necessarily repealing the standard, but giving the utilities a pass to what you've done so far is fine. In that context, very interesting that California, in the recession, does approve a higher renewable portfolio standard. So, I didn't expect that, and so I think that's, an interesting counterbalance. But I think in a lot of places, wouldn't be surprised to see commissions say, hey, you're halfway there, that's fine.
Well, that raises an interesting point, and I think part of the reason why you saw that in California was their sense that a lot of the components, a lot of the actual industry that was going to supply that renewable portfolio standard was there in California. And it really is a piece of the industrial policy of the state of California to be a clean tech cluster, and to be the heart of that growth. And so, to them, it was really more of an industrial policy or a jobs policy.
Yeah, actually, I'd jump in on that and ask Rob. I mean, we saw an election recently in Ontario, which the Liberal government beat back a challenge, and did we see a similar phenomenon there where they were able to make the argument that economic development was taking place, and that managed to have that, that was essentially a sticky issue, whereas as Mike points out, in other parts of the world where you're just saying, listen, take this slightly higher priced electricity, but you're not going to see any manufacturing jobs. It doesn't work. I mean, is that part of the story, Ontario, or not?
Yeah, I think so. So let's just give the audience a bit of perspective. So if you produced electricity from a gas-fired generator today at $4 an MMBTU, it's going to cost you about 4 to 5 cents on a wholesale basis. Give you some perspective. With the quality, I would say, of the wind resources in Ontario and the cost of turbines and everything else, if you put that all into the mix, it's about 11 cents, okay? So give or take, wind power in Ontario is 2 to 2.5 times more expensive than if I built a gas-fired power plant today. So to give you some perspective.
Although, just to jump in, at least you do know that will be that same 11 cents
Absolutely.
10 years from now, right? Whereas we do not know what natural gas prices will be 10 years from now.
Yeah, no, absolutely. So there could be a crossover point. If gas goes to $15 an MMBTU, then obviously the wind was cheaper at the end of the day. And that's some of the bet, is that over a 20-year time frame, gas is not going to be $4 an MMBTU forever. But I think I guess I'd pose the question is it wrong for either a state utility commissioner or a politician to say, the people told me they're not ready to pay for renewable power yet? I mean, I know we need leadership in our people, in our politicians and folks like that, and I think we do need to sometimes lead the public as opposed to have the public dictate all the time what we should be doing. But I think when you're a state commissioner, and I agree entirely, if you're a state commissioner in a mountainous state and you've got tons of hydro pouring out of the mountains, you should be tapping all those resources, whether there's a renewable portfolio standard or not, frankly. You should just be using the resources that you have available to you. If you're also a state with tons of gas that's coming out of the ground, candidly, maybe you should be using more gas. So we need to look at it on a more holistic, what's the best answer for the system? And the system is not necessarily defined by political boundaries. That would be my personal view. That's not necessarily the view of the organization I work for. But I think the point with Ontario is, it's an interesting transition. I think many people sort of said, okay, we'll give you credit for the jobs you created through the policy you did. But we also had actually a rural backlash, which is relatively unique in the sense that that party really didn't get any electoral votes from anybody outside of the cities. And much of that is attributed to the fact that the rural community, frankly, isn't terribly happy about having wind farms on their locations. So it's an interesting conundrum that, do we create jobs? Are we creating electricity? What are we doing to people's habitat, and are they comfortable with that? So all of that has to go in the mix. And I think, before coming into this session, I was listening to the microfinance section, and I asked the question of what's a fundamental thing that you did correct in your implementation of your microfinance? And in both cases, they said, we listened to the local people and we responded to what they wanted. And to some extent, I think we as a community here trying to think about the environment and what we do good for the environment is important. And there's some push we can make and maybe some pull along we can make as well. But fundamentally, people have to be there too. They have to be willing to make that commitment. And again, in Ontario, you're effectively asking people to pay twice the cost of power. And if they're prepared to do it, the projects will get funded and we'll build them. There's no question at all. If they're not prepared to, then we won't. And that's kind of the way, I guess, the capitalist system is designed.
Great. Well, listen, if it's possible, can we take just a few questions? And then I think we've got to wrap up here. Beneath the light, I see someone with a hand there and someone with a microphone behind it.
Hi, my name is Jonathan Rothwell from the Brookings Institution. I've got a quick comment and then a question for the panel. Just on the cost of gas, I just feel like it needs to be said that once you consider the externalities of gas, it's not clear to me that it's any cheaper, and I would suspect that it's considerably more costly. So that speaks to the importance of putting a comprehensive tax on energy production. And in fact, I would think that there's been new research. Just let me cite one paper from the American Economic Review. A new publication came out suggesting that roughly $150 billion, or 2% of U.S. GDP, is lost every year from air pollution. When you consider the magnitude of the differences between external damage, not just from carbon, but other environmental damage from natural gas and coal, I would think that that some of these renewable technologies would pay for themselves. So that's my comment. Thank you for that. Getting to my question, especially for the financiers on the panel, what are some projects that are on the cusp of being approved that come across your desk involving renewable technologies, but don't quite make it for whatever reasons, whether it's technological risk or lack of demand? What are some of the factors there?
Yeah, why do we say no thank you to things that got close but not quite? Yeah, that's a great question. One thing we've seen is, I think about in biomass transactions, you'll see a lot of power purchase agreements aren't a pass-through of the wood cost, but they're rather indexed to what the utility is paying for another fuel, coal, and we just won't take that risk on the fuel cost pass-through. So that's been one stumbling point on financeability. One of the interesting aspects of renewable energy is that most financial institutions lost plenty of money in this area in the 80s. And so we're mindful of that, and we're hoping that renewable energy is not like in this decade is not like marriage, the triumph of enthusiasm over experience. But from that experience in the 80s, I'm doing a little bit of a flippant sideline. But we saw what broke in the 80s, and so we can look out for that now. So there's in a way fewer traps. So in the 80s, we saw a wind turbine manufacturer get into trouble, unable to the turbines were wearing out faster than expected, and they couldn't make replacement parts. So we now build that into how we look at turbine manufacturers today, and we've been able to build off of that experience. So we are a little bit cautious about, feel pretty good through 10 and 15 years. How much of the loan do we still want outstanding in years 15 through 20 through 25? So sometimes if it's too long, that'll back us off on wind. On solar, some of the solar trough technologies had too much debt put on them in the 80s because there was an expectation of that they'd have higher production. But once restructured, those have performed fine. PV panels, those have performed well in our portfolio. So I think we don't really say no thank you to PV these days. Usually we lose those because someone else is just pricing it cheaper than we are, likes it better than we do in a given case. I think solar power towers, that's one where I don't think we're ready to make a loan into a situation like that. We're not ready to advance 5%, 6% capital, but I think that's one where the innovative technology program is great because they're getting built off of one or two at demonstration scale. Now we'll see a utility scale project out there. It'll perform for a couple of years, and then investors like us will be comfortable coming in. Is that fair, Rob? Or?
Yeah, I think that's fair. I think the other comment I would just make, so back to your gas comment, I agree 100%. It's absolutely true. It's just that we're not asked to finance all the externalities. So candidly, hear you, agree with you. Right now, we're not facing that. But I think the other aspect is I take care of the energy technology side for RBC as well, which is not just renewables. It could be smart grid technology and any of those things. And I would say that there is phenomenal runway for efficiencies to be eked out of the system on relatively incremental processes. And what allows us to do that, for example, if somebody comes in and says, I want to implement all these new meters in my service territory, as long as they have the regulatory compact to make that happen, absolutely it gets financed. So I think I agree with, fuel on biomass, with new technologies that are, looking for, candidly, more. If you look at a general corporate enterprise, if you looked at most, J&J, if you looked at any U.S. industry, nobody really has more than about 50% debt on them, okay? That's just a rule of thumb. But if you looked at a project, people expect to get 80% debt on it. And I'm sitting here scratching my head, is that, hang on, but if you were a corporate enterprise, I would only lend you 50 cents on the dollar, but because you're a project, you want 80? And that works in certain circumstances, but it doesn't work when you're asking me to take on the same risks that you would be as a corporate enterprise, like R&D, like technology, like those things. So understand that, look, there's a certain amount of debt you can always put on any project, but if it's got a high risk profile associated with it, maybe it's only 20%, and you have to have 80% equity rather than the flip. And that's kind of where I think that's where people get the misconception is, oh, there's no financing available to me. There's absolutely financing available to you. It may not be debt, though. It may be equity. And that's the risk-reward takeoff.
Well, and I guess just expanding on that, and then I have to get back to the comment. I think the issue is, for a lot of these projects, particularly the ones that the Loan Guarantee Program has done, we're talking about billion-dollar-plus projects. And so, to do that, 60% equity, there's just not the capacity in the equity market to do more than a couple. And what that really gets down to, obviously we could do that, and typically we have, historically. The question is, does that keep up with the competitive pressures? That kind of a pace. If we build 2-3 large-scale projects a year, does that, are we even in the game at that point? And I think that we would sort of assert we're not. So that's not a comment on the banks. That's just sort of a recognition of that is the crux of the problem that these projects face. I think on the larger comment, I would just say, this is sort of my personal editorial on it, is, obviously the mother of all subsidies in the energy game is not pricing the externalities and imposing that on the rest of society. So, that just is, and that is the main thing to be addressed. My personal frustration, having been now on the committee for 7 years, is I watched, that fairly straightforward point that we must price this externality. Society is today paying this cost, and will be, and is going to be paying a lot more in the future. Got that turned into, a cap and trade system that traded this for that, and to try to get all the machinations of sort of trying, how do you politically get something through? And my personal view is that the fundamental message, the purpose of the enterprise got lost. People started talking about how much money it would raise, and how much we'll give this much money to the deficit, and we'll do this much for this, and you kind of, I think we do need to kind of be conscious of keeping our eye on the ball a little bit on this, and that really, my takeaway for the way this debate has played out is that we lost it, and that we ended up talking about a whole bunch of other things rather than just that fundamental point.
Yeah, agreed. And thanks for that question, Jonathan. Actually, I think with that, I'm going to have to wrap it up, because I think we're just after 5 o'clock. So I hope everyone sticks around. I believe there's a dinner and drinks later this evening. So thank you very much for your time and for your patience. Appreciate it.